Egie, it's great to have you on the show. And I was just talking about the equity market. Clearly, things are looking up. What I'm hearing in the fixed income space, we're seeing yields come down.
Yes, as you've been saying on your shows all week, there's been a slight reduction in the yields. T-bills down about 40 basis points. Secondary market bond yields also slightly down from well over 16% earlier in the past week.
All right, and that 16% level is something that I think is even worrying the government. But we're also hearing that there's a bond issue next week. Give us some perspective on your expectations there. 75 billion is what I hear the government is trying to raise.
Yes, I mean, given where secondary market is right now, which is above 16% for the longer dated securities, you should expect issue yields around the 16% levels.
Okay, and then let's talk about the whole discussion around debt ceiling. We're hearing that the government is under some pressure from the National Assembly to cap borrowing. But let's get your perspective on that. The government has also come out to say, okay, our borrowing levels are still at very comfortable levels. I think that's what the Minister of Finance said when I spoke to her yesterday. Your thoughts on that whole discussion?
Well, I mean, as the minister did say, the issue is the trend. The trend has been significantly up over the past few years. It'll be good if we could point to specific self-generating projects that have been used, that the proceeds of these bonds have been used to fund. But you'll be hard-pressed to find anything substantive on ground where this money went. So the real question is not
deficits.
What was the money used for? Exactly.
The current expenditure, etc.
Exactly. So, I mean, you could go to 30% ceiling, as the minister did suggest, 25 to 30, and have absolutely nothing to show for it. You run into trouble paying back. So
okay,
really,
and then, of course, there is the crowding out effect of this borrowing, and that's something that's also worrying people. From where you stand, I mean, you're obviously advising corporate and subnationals. Are we really seeing that impact? We know clearly there's pressure from the perspective of yields because it's difficult for corporates to borrow at the current level. But your thoughts on the crowding out, the fact that the federal government it's just out there and is borrowing so much?
Well, I mean, on one side, you might say that the borrowing levels have come down from over 1 trillion in 2010. This is DMO bond issues. It went to about 850 last year and coming to about 744 this year. So the trend is down. Unfortunately, that downtrend has also come at an increasing price. So if you look at the spreads, the FGN yields prior to the MPR move of the CBN in October, they were under 12%. MPR moves up 2.75%, and then you get over 4% move in the bond yields. So there's actually been a disproportionate upward swing in the bond yields, and it's primarily because the government is issuing a lot of paper on the short end, and also the longer dated bonds have come down in the amount being issued, but it's not as the reduction is not significant enough for us to feel it in the market. So you have a situation now where you have to price your bond above the federal government at 16%, whereas 9 months ago you were pricing a federal government bond at 11.5. That's very significant cost that very few entities can afford to carry over the long term.
Okay, I want to get your perspective on something that has also come up recently, and that's the concept of a sinking fund to retire some of these bonds. Clearly, the government is paying more attention to the rising debt levels, and they're looking to see how they can bring that down. They've obviously tightened on the fiscal side. Many people are saying they haven't done enough, but at least they've started the process. But then there's also the issue of this sinking fund that we're hearing is designed to retire bonds that mature in the future. What's your thought on that? Because it sounds a little, should I say, very unusual for a government to be doing this.
Well, we'll need more details on that. Yes, it is unusual for a government that has issued bullet repayment bonds to have a sinking fund to go with it. I mean, for instance, I mean, even in the private sector, we do have companies in Nigeria who have issued bullet repayment bonds without a sinking fund, subordinated debt. So the question is, what's this money going to be put into? Is it going to just be sitting in the central bank at 0% to retire 15% bond, or will it be invested? And it's neither here nor there what you put the money in. The question is, how much debt are you taking on every year? And as long as the debt stock is rising, even if you have a small sinking fund, I don't think it's going to make any significant difference. The bonds are already AAA rated anyway, so even if you put a sinking fund, the rating is not going to change, and I'm not really sure what overall benefit it's going to serve.
Okay, let's look at inflation and to what extent has come into play. I know in the past, especially when it was at sub-10 levels, it was a factor. It was something that many bond investors, fixed income investors were looking at. But at the current levels, and we know that the numbers for June will be out next week, to what extent would you say the inflation numbers play a role in investment decisions?
Well, I mean, if you're a pension fund, you want to have your long-term investments yielding above inflation, which is clearly where we are, even for the 20-year bond that is yielding about 14.6. When those numbers come out from time to time, you see a spike in secondary market rates. But historically, the inflation rate hasn't really been the driver of yields. It's really demand and supply. Supply of securities and demand from how much money is in circulation. If you go back to 2010, you had federal government bond yields single digits below inflation. Now we are back into positive territory, but you might see a spike when the results of inflation are announced, but really it's demand and supply that drives these rates.
I mean, from the trends you're seeing now, do you think that's a possibility? I mean, what you just mentioned about 2010, do you think conceivably we could see bond yields below inflation?
Well, if inflation runs up significantly and the government was to cut back on borrowing, then that could happen. But given the fact that we are more or less near record high oil prices and you have this level of borrowing, and what are the odds that oil prices drop 20–30%? I mean, the borrowing is not likely to drop enough for the government to have to start issuing bonds below inflation rates. So on the short term, that's not likely.
Okay, I mean, let's look a bit forward now, going into next week and perhaps even the rest of the quarter. How do you see yields playing out? I've heard mixed views on this point. Some think because of the dynamics of what people are calling Nigeria's version of Operation Twist, where the DMO is looking to switch on bonds, that could put some upside pressure on yields. On the other hand, people feel like we're already at the top of this cycle of tightening. Yields can only come down. Where do you stand on that argument?
Well, it's, again, I mean, we didn't really predict this kind of 16+% yields a month or two ago, so it's hard to predict what's going to happen down the road. It's fair to say that we are not going to see yields drop 2%, and it's not likely they'll go up 2%. But again, we shouldn't forget October 2011, DMO issued a 7-year bond at 18% yield. So those 18% numbers are not impossible to retest, but they're unlikely. We'll probably trade within a range 1% above or below where we are right now.